Okay, good afternoon and welcome back everyone to another session of our options education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And we are kicking off another earnings season, and we are going to discuss how we identified the best trading stocks for earnings season and do a review of the upcoming week with regards to the opportunities that we feel have the best possibility of making a big move on earnings and how you can potentially capture that utilizing options. Now, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities as example purposes during today's session. Now, my goal today is to show you how to identify stocks that have the highest chance of making a big move on earnings and showing you the three-step process that we use to identify stocks that will make a big move on earnings so that and more importantly, how to access that list every single week, which is our new AI powered research report that has these specific stocks with the highest probability of making a big move on earnings. So a lot that we're going to cover during today's session, but we're going to spend as much time as possible using the platform, going through the specific symbols that are going to be reporting next week, and how you can use that every single week to find explosive moves for trading options. Now, most of you are familiar with our earnings calendar. It is something that you can find on the OptionsPlay platform. If you're not familiar, within the OptionsPlay platform, on the upper right-hand corner, you can click on the hamburger menu, and within that, there is an earnings link that you can click on, and that takes you to our earnings calendar. Now, the earnings calendar is incredibly powerful because on any given day, there are sometimes hundreds of symbols that are reporting, especially during the meatier part of earnings season. So when you have a day where there are potentially 200, 300, 400 symbols reporting on a given day, how do you know which ones you want to trade and how do you narrow it down? So first of all, our earnings calendar is designed to give you a clear understanding of which symbols on a given day is most likely going to be the earnings calendar is telling you which out of all of the stocks that are reporting, which ones are most liquid. And just by that alone, what you're going to do is filter out the vast majority. You're going to filter out about 97, 98% of the symbols that are reporting on a given day just by looking at options liquidity. So the ones that are highlighted in green are the ones that are most liquid. The ones that are highlighted in yellow are somewhat liquid, and anything that doesn't have a color on it, meaning it's white, means that those symbols are not liquid and it's not worth even thinking about when it comes to earnings season. So in the meatier part of earnings seasons, you can see on a given day, there generally are a handful, usually about a dozen or so stocks that are what we consider incredibly liquid from an options trading perspective. And that gives you a good sense for which symbols you could potentially trade on earnings. And it's sorted for you based on before or market, before, whether it's reporting before or after the market close. So on a given day, anything that has an asterisk sign, which is always at the top of the list for that given day, those are the symbols that report in the morning before the market opens, and the ones without a asterisk sign are the ones that report in the afternoon. So it's organized in a way that's relatively easy for you to find opportunities. And then what that means is that on any given day, you basically have a handful of stocks that you can look at for the next morning or the next afternoon that you can research to potentially trade for earnings. And it significantly reduces the amount of research that you typically have to do on earnings because it immediately filters out 98, 99% of the trades or 99% of the symbols that are reporting on a given day. Now, here's the thing, is that just because these are all the symbols that you could trade doesn't mean that these are the symbols that you should trade. So what I want to do is I want to walk you through a three-step process that we use to identify when you have a list of liquid symbols, which ones should you trade. And then what we'll do is we will then go through and showing you kind of from next week's earnings, which ones meet all of the criteria of the exact three-step process that I'm going to walk you through here right now. It's going to be relatively simple, but the proven earning strategy that we have that I want you to be able to follow along is a simple three-step process. What we're looking for is absolute trend, relative strength, and combined fundamentals. We need all three things to align with each other. The first one is absolute trend. This is fairly straightforward. We're just looking for the trend of the stock to be trending in one direction or another. So either the stock is trending higher or the stock is trending lower. Relatively simple to look at a chart and see whether a stock is trending in one direction or another. The second thing we look at is relative strength. What we want to do is we want to see relative strength that aligns with the stock's overall trend. So if you have a stock that's trending higher, not only do we want to see that stock trending higher going into earnings, we want to see that stock outperform the market as it trends higher when it goes into the earnings report, because that is a good sign that potentially there is some level of accumulation, whether that's institutional accumulation or accumulation by a vast amount of retail traders combined. That gives you a good sense that traders are buying or picking up the stock faster than they are the rest of the market going into the earnings announcement. Vice versa, if you have a stock that's trending lower, we don't necessarily just want to see the stocks trending lower. We want to see that it's not only trending lower, but it's underperforming the market. And that gives us a sense that potentially either a large group of retail traders or institutional traders are distributing that stock ahead of the earnings season, meaning they don't want to own the stock going into that earnings report, and they're selling that stock at a faster clip than they are with the rest of the market. And then lastly, what we're looking for are fundamentals that align with the first two. So the first two are really kind of looking at the technicals, right? Trend is looking at the chart. Relative strength is looking at the chart relative to the market. The third one we look at are fundamentals. And for those of you that follow us every single week, you know that we look at valuations with respect to growth and profitability. We generally want to see stocks that are undervalued relative to the growth and profitability compared to its peers, or stocks that are overvalued compared to the growth and profitability versus its peers. So this is a simple method that we use. But if you use this specific method, you'll see that on a given week, if let's say there are 10, on a given day, if there are 10 liquid optionable symbols, this proven earning strategy will likely filter out, again, 8 or 9 out of those 10 symbols on a given day. So you really just have a handful, 1 or 2 of what we consider are the best opportunities for earnings season that you should trade. So just to be clear, the earnings calendar gives you a good sense for which ones you could trade, and this particular earnings strategy will help you identify which ones you should trade. These are the stocks that meet all three criteria, are the ones that we believe have the highest probability of making that big move on earnings, meaning they're likely going to surprise to the upside. So when the earnings number comes out, these are the stocks that are likely to make a big jump higher or a big jump lower. The ones that you ideally want to trade on earnings. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Perfect. So let's just go through a couple examples of this on stocks that meet these specific criterias. And we'll go through them one by one, and we'll look at the underlying fundamentals for each one. So looking at Moderna, this is a good example of both absolute and relative strength. What we're looking for are stocks that have outperformed, itself. So Moderna has been kind of trading sideways for quite some time between, call it 24 and 29, a $5 trading range for roughly 3 months, and it recently just broke out a couple of weeks ago. And here's the thing: is that on a breakout, that's not enough to say, okay, this is a good trade for earnings, because the market's been in a positive market. So if this stock is just going along with the market, that's not enough evidence to say, this is potentially a good trade going into earnings. What you want to see is that alongside with that breakout here, it has outperformed the S&P 500 during that breakout. That's a much better sign that we like to see going into earnings. So that's what we mean by absolute and relative strength. Now, if we look at Moderna from a um, valuation perspective, right? So Moderna trades at 10 times forward earnings, while the market is trading somewhere between 10 and 11 times forward earnings. So it's trading roughly in line with the rest of the market. So this is really where we look at this particular stock. You look at growth expectations, EPS growth of around 18% versus the market's around 14. This is a stock that's expected to grow faster than the market. So this is really where we think that Moderna, with the relatively strong technicals and the strong fundamentals, this is a potential opportunity for earnings. The second opportunity that I want to just kind of give you a sense for is T-Mobile. And for those of you that have been following us, we've had a bearish view on T-Mobile here for multiple weeks now. We've been bearish on this particular stock ever since it broke down below 250. So the stock's now trading at 226. It's continued to move lower here. This is one, as you can see, recently it broke below that 230 support level here. And not only did it break below that support level, it also continues to underperform the S&P 500 as it moves lower. So it's not just moving lower, it's being distributed relative to the rest of the market. And T-Mobile trades at 22 times forward earnings versus the industry is around 11 times forward earnings or 10 times forward earnings. So we're talking about a stock that's trading at more than double the industry valuation, even though a T-Mobile does grow a little bit faster than the industry and slightly more profitable, but not profitable enough, in my opinion, to justify a valuation that's more than double its peers. Both AT&T and Mobile fall into this particular category. They've both underperformed the market. They both have been trending lower, and they both have valuations that are higher than the industry average. And for those reasons, we believe that there is further downside, especially going into that earnings report. There's a risk that potentially those stocks will underperform going, after the earnings report. So it's a relatively simple process, but even going through that simple process takes quite a bit of time and research to do all of the work, because on a given day, there could be 15, 20 symbols that report, and it takes a lot of time to go through 15, 20 different charts and go through 15 to 20 different fundamentals, which is why we've built our new AI research report that comes out every single Monday during our Monday morning trade ideas report. And we go over that during our Monday morning webinar, Monday morning trade ideas session for those of you that are members that have access to that report and access to that session. This is really where we look at kind of all of these things that I was referring to with regards to looking at the technicals, looking at the fundamentals, and then we are publishing our earnings navigator research every single Monday morning. So this is something that I'm giving you a preview for what next Monday morning's report is going to look like, because next week is kind of the big, when we kick off a big week in terms of earnings. And we have, I believe, 8 stocks out of all the stocks that are reporting next week that have an earnings opportunity. So let's take a look at the earnings calendar real quick. Just log into that real quick. Sorry. All right, so here's the earnings calendar for next week. As you can see, there's a good number of stocks that are reporting next week, and there are probably, as you can see here, call it 30 stocks that we consider very liquid from an options trading perspective. So it's certainly a much further, a significantly reduced list of stocks that you have to research, 30 stocks versus a few hundred that are reporting next week. But what we want to do is actually do the research for you, looking at the trends, looking at the relative strength, and looking at the fundamentals, and giving you a sense for which stocks have the best opportunity of a big move. They're color coded for you based on whether it's bullish or bearish. So out of the bullish ones, we have Alphabet, Dow Chemical, Union Pacific, and Newmont Mining. On the bearish side, we have Tesla, Philip Morris, T-Mobile, and AT&T. I'm sorry, Dow Chemical was bearish. Sorry, I apologize. It's Alphabet, Union Pacific, and Newmont Mining that's bullish. So let's take a look at those particular stocks using the OptionsPlay platform, and let's take a look at some opportunities here. The first one I want to take a look at here is Alphabet. So for those of you that have been following, I've been bullish on Alphabet here for quite a few weeks here. Alphabet generated a buy signal when it pulled back here to this trend line a couple of weeks ago, probably closer to 3 weeks ago now. And this stock has had a really nice rally since it generated that buy signal. That was a trend following buy signal that we got on our platform. And not only did we had a really nice rally from there, it recently broke out above this 180 level here. So we broke out above 180. As you can see, the trends are positive. It's outperformed the S&P 500 during that time. And what we're looking for is a continuation higher here. We have a gap fill here at 202. That's our upside target here for Alphabet. That's in our equity research report that we put out every Monday and Thursday. You got another update on that this morning. And the valuations here for Alphabet look incredibly compelling. You're trading at about 19 times forward earnings with net margins that exceed 30%. The industry average net margins around 7%. So when you have a stock that has profitability that's head and shoulders above the industry, yet it trades at the same valuation as the rest of its industry, that's really where you have a compelling opportunity where based on the numbers that come out here tomorrow, next week, we could potentially see a big move here to the upside on Alphabet as a particular stock. So these are the types of trades that we like to place going into the earnings announcement. Now, how do you want to place these trades? Well, this is really where you can look at IV rank to help you gauge, perhaps what might be a good strategy for this. As you can see, IV rank right now, for considering we're heading into earnings at 22%, is relatively low. And what that tells me is that you can potentially have an opportunity where you could look at buying options rather than selling options as more advantageous. So this is really where, when it comes to earnings, I typically would like to go for a shorter dated expiration rather than a longer dated one, especially when I'm trading something like a debit spread. So you can either look at a straight call option, right? So basically buying maybe a August slightly out of the money call option, like an August 185 call for $7.28. Or you might want to look at a vertical spread here, where you might look at the 185. My upside target is 202. So I'd be looking at maybe a 185, 200 call spread. As you can see, that's $4.87. So in my perspective, one costs 728, one costs 487. I'm more likely to go with that one that costs 487 because by reducing my risk on the trade, I'm going to significantly increase my potential return on this particular trade. So this is really what as you can see, if the stock does reach my 202 target here, that's the target that I have here in the P&L simulator. If I've just bought the call option, I look at, 142% return is nothing to sneeze at, right? But as you can see, the strategy here on the right, the vertical spread will give me a 208% return if I traded that, even though it's exceeding the upper strike of my vertical spread. Here I'm selling the 200. I'm looking at this. What happens if it goes to 202 and a half? Even though it exceeds my upper strike, I'm still getting a significantly higher return on that vertical spread because the vertical spread costs so much less. It's taking so much lower amount of capital to get in that it's going to significantly increase my return if I am correct on the trade. And more importantly, if I'm wrong on the trade, I'm risking substantially less on that vertical spread. So I am inclined to trade something like an August 15th, 185, 200 here on Alphabet going into earnings. And what we can do is we can even paper trade this using the OptionsPlay paper trading portfolio. And what we can do is we can add this trade to our portfolio. And what I'll do is I'll do a session here in 2 weeks' time where we'll come back and we'll look at all of these trades together, how they've performed. We'll look at kind of, the earnings navigator, how it worked out, and how all of these trades, and we can collectively look together and see how these perform. Okay. And the next one we'll take a look at here is Tesla. Let's just look at this is the Navigator research, right? So the first we just looked at here is Alphabet. Now let's take a look at Tesla. This is really, this reports here on the 23rd. It looks like Alphabet reports on the 23rd as well. I have that wrong on that one. I'll rectify that when it goes out in the earnings navigator. The next one I want to take a look at here is Tesla. And we've talked about Tesla as well in our earnings and our equity research. This is one of the stocks that we have a bearish view on. As you can see, recently just generated a bearish trend following signal here today, right? So that, as you can see here at the bottom of your screen, and this is really one of the great things about the OptionsPlay platform is that it'll give you kind of signals. And the other thing you can do is you can actually look at, just out of all the trade ideas, which ones have also aligned with kind of whether it's overvalued or undervalued. As you can see, Tesla is actually one of the stocks that has generated a bearish trade idea and is considered overvalued. And that's actually how we help identify these as a potential opportunity for earnings. Joe saying Tesla always makes me nervous. Tesla makes me nervous all the time as well, which is why if I'm ever going to trade Tesla on earnings, I'm always going to trade options to limit my overall risk, right? So, as you can see, Tesla has been recently trending lower here a little bit. It's underperformed the market as it trended lower. This is really where we're looking for some potential downside here. But the story is really rooted in fundamentals. Tesla trades at 166 times forward earnings. The industry median is around 11 times forward earnings. So you're talking about a valuation that's 15 times higher than the industry. So you could say everything you want about what's optimistic about Tesla, robo taxi, humanoids, battery technology, better cars coming out, whatever it is. I really find it incredibly difficult to justify a valuation that's 15 times higher. So for those reasons, I'm going to take a bearish view on Tesla going into earnings. So the best way, in my opinion, is to also use a similar type structure. Now, IV rank here for Tesla is a little bit higher at 34%. So you could potentially look at selling options here as well. But, if you look at selling a call spread here, look at the August 29th, 323.70 call spread, see the risk reward ratio here is quite poor. You're risking 1,500, you're risking 3,500 to potentially make 1,500. That's not a credit spread that I feel like is the right risk reward ratio for me going into an earnings announcement. So in this particular case, I think I would be opting for the debit spread. I also would probably look at the August monthly expiration. Earlier today, I was looking at the 315-280 put spread. You can trade this for a little over $1,100, $11.63. Gives you about a 2-to-1 risk reward ratio on a move lower here. As you can see, the expected move here for Tesla is 6.72%. Whoops. 6.72%. So let's take a look at that. 6.72%. So 320, let's call it 320 times 0.672% is around $21. So you're talking about a stock moving from around 319 to call it let's call it 298 or so. What does that look like here for each of these strategies? Not a significant return on either one of these particular trades. So this is one that you might want to take a look at and say whether or not this makes sense to you. So let's just kind of put this back up here. 298. So 298 on the day after expiration. Let's say on the Friday after expiration, you're looking at about, these two strategies are very similar, right? Whether you buy the put or buy the put spread, around a 53% return. So, if these two have a very similar return, I'm always going to trade the one with the lower risk in terms of the trade cost, because then it lowers my absolute risk on the overall trade. So if I trade the same number of contracts between the put and the put vertical, if I expect a similar return, but one has lower risk, I'm always going to take the one with the lower risk. And that's why that strategy on the right has a higher options play score. So hopefully this gives you a sense for kind of how we are looking at earnings season. Let's just also trade this into our paper trading portfolio, so we have something to look back on in a couple of weeks' time. But as you can see, this is really where we can basically take the stocks that we publish in our weekly research and weekly earnings navigator. And again, for those of you that missed it, this is something that we publish during our Monday morning research report. So we publish a Monday morning equity research report for all of our members. We also do a Monday morning trade ideas webinar to go over those equity ideas. And that's where we publish these earnings navigators trades for the upcoming week. So I'm just giving you a preview of what is coming in that earnings navigator research on Monday morning next week right now, so that you can see how this process works. We're going to go through a couple of more examples, and then what we'll do is we will wrap this up, and we'll come back here in a couple of weeks and look at how those strategies performed in a couple of weeks. What's another one we want to take a look? Let's look at T-Mobile, because T-Mobile is another one that's been in our equity research report. We have had a bearish view here on T-Mobile. Like I said, trades at 22 times forward earnings. The stock has been trending lower for quite some time now. It's underperformed the S&P 500. IV rank is 42%. So this might be a better trade for selling premium here. Let's take a look at that. That looks much better. Selling that 230, 240 call spread will risk 548 to make 452. That's a much more balanced risk reward ratio on a credit spread. So that would be one that I'd probably be more inclined to be selling premium on rather than buying premium. And also, if you look at, just generally speaking, the expected move for T-Mobile it's a smaller move that's expected, about 4.37%. So because I'm not expecting that explosive big move, this is really where selling premium might be more suitable. And as you can see, the platform really helps you structure these trades very simply, very easily, so that you can kind of focus your attention on research and not have to pull up an options chain, figure out what strategy to trade, what expiration date, what strike price. It really does a lot of that work for you. Click on the trade button. We'll enter this into our paper trading portfolio, and we'll track that here as well. And for those of you that don't have a paper trading portfolio set up yet, when you click on the trade button on any of these specific strategies, you can create a new personal portfolio by clicking on this this plus arrow here, right in here. So if you don't have any portfolio set up yet, this is a great way for you to track either a paper trading portfolio that you want to make, or if you have a live portfolio that you are trading, especially if you have multiple trading accounts, if you just simply create one for your, let's say, your Schwab account, one for your Tasty Trade account, one for whatever brokerage firm you have, every single time you place a trade, you just enter it into OptionsPlay. You can put the price at which you got filled. So let's say you got filled, let's say you got filled on this at, let's say, whoops, let's say you got filled at 450 on this credit spread, you can put in your premiums that you got filled at, enter it into your paper trading portfolio, and now you can track all of these trades in the portfolio tool within OptionsPlay. And we'll take a look at that here in a couple of weeks of these specific trades that we made. And you can look at, specific portfolios, and it really makes it easy for you to track, all of your portfolios in one place. So we look at all the positions and then give you notifications, for example, if something has generated a bearish position for today, or if there are anything that have generated a stop loss or take profit in this particular case. I don't currently have anything right now on that, but this will give you kind of alerts as far as opportunities to take profit and cut losses. So as you can see, the Alphabet trade that we just entered is here. The T-Mobile trade that we entered is here, and the Tesla trade we entered is right here. And we'll come back here, like I said, in a couple of weeks, and we'll look at how these strategies perform and collectively look at trading, look at how these, how we can potentially adjust any of these positions if necessary in a few weeks. And it'll also give us a sense for how the earnings navigator performed during that time. So with that, that covers what I want to share with you here today. Hopefully this gives you a good sense for how to approach earnings season and how to find the best trading opportunities every single week using your OptionsPlay platform with your membership. The earnings research is our earnings navigator to help you identify the best stocks for earnings season. So